If you're the Saudis, what do you want? Do you want 290 ounces of gold, which has appreciated by 9.9% per year for 25 years, outpacing every traditional asset, period, that the Bank of International Settlements has reclassified as the world's only other tier one asset that the central banks are buying at a level the world has never seen before and repatriating it, including Saudi, who brought all their gold home from the Bank of England and the New York Fed, the two traditional places of safety that would give access to the hubs of trading, the LBMA and the COMEX. Do you want gold? That's what these entities are doing. They're saying, I don't want dollars anymore. They can be weaponized. They're being inflated. It's crap. I'd rather have gold, which has a much better track record, which can't be inflated, which can't be weaponized, and has been reclassified the world's only other tier one asset by the most powerful bank on the planet.
Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. Since 2008, gold has outperformed U.S. stocks and treasuries during the most notable market crises. This reflects gold's role as a hedge against financial risks and a safe haven amid uncertainty. Some of VanEck's own experts suggest that the case for gold may grow stronger due to the potential decline of the U.S. dollar's reserve status and the emerging market central bank's gold holdings continuing to rise. A prominent figure in the financial services industry, AndySchectman, emphasizes that nations are turning to gold due to its strong performance, inflation resistance, and Tier 1 asset status. Highlighting a significant trend, Andy reveals Saudi Arabia's secret gold purchase. He notes that various risks are driving this shift, with Saudi Arabia now diversifying its oil sales away from exclusive dollar transactions. Analyst Jan Nieuwenhuijs from Money Metals exposes a startling truth that Saudi Arabia might secretly accumulate gold. He estimates that a staggering 160 tons have been purchased since 2022 in Switzerland, contributing to the current gold rush. This strategy contradicts the nation's historical role in establishing the petrodollar system. Based on fundamentals, Andy emphasizes that gold has outperformed traditional assets, with a notable performance doubling that of U.S. treasuries over the past 25 years. The bond market, already strained by rising interest rates, may experience further downward pressure as foreign nations reduce their holdings of U.S. Treasury bonds in favor of gold or other currencies. Recently, China has taken a significant step that further complicates this fraught relationship by cutting ties with a record number of U.S. Treasuries and agency debt bonds worth $53.3 billion. Now, we present the clips of AndySchectman's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
There is some truth in that, in the respect that the entities that are accumulating gold, largely the central banks, understand that holding dollars is not smart, that they will be eroded to inflation. And think of it from the standpoint of like Saudi Arabia, okay? One of the newsworthy stories is that Saudi Arabia secretly purchased 160 tons of gold from Switzerland in the month of August. And they say secretly because they didn't make a public announcement or any disclosure of the change in their official reserves. Well, China's been doing this forever. Most of the countries who accumulate gold don't want to tell the world how much they own, or they'll say, we're not buying this month, and then it's exposed that they were lying because the import numbers that are required to be detailed by the banks, well, they say otherwise. And I knew that they were still buying, but the point of it is that think of it from your Saudi Arabia, right? So they've been loading up on gold, and they're trying to do it quietly and covertly so as to not upset the West. What did they do a few weeks ago? They said, hey, we'll still take dollars, but we're not going to do it exclusively. We're going to not re-up the exclusivity of the petro deal that's 50 years old. So what that says to me is that the hegemony is dead, not the supremacy. So they're playing both sides. But okay, let's just say we're Saudi Arabia, and the deal that we had for 50 years is we're going to sell oil to you through OPEC in dollars to the world. And then we'll take any excess and put them into treasuries. Well, the treasury side, you and I have covered extensively. I mean, they've been weaponized, right? We take Russia's $5 billion in treasuries because we don't like what they're doing, and we buy weapons from the military-industrial complex with it to give to the country they're in a war with, the Ukraine. That doesn't go over well to the rest of the world. We are supposed to be impartial. We're not. And by many people's estimation, we're more hypocritical and worse than anything Russia has done. I'm not going to debate that, but part of the world feels that. Okay, so the treasury market is not looked at the same way. And gold, which has doubled the performance of the treasury over the 10-year, over the last 25 years, has no counterparty risk. Okay, fine. So we don't want treasuries anymore. We're going to buy gold with all the excess because it's better. The performance has no counterparty risk. Well, how about selling your oil for dollars? A dollar, which the Fed tells us is 2% inflation is what they're striving for, yet they're pivoting at 3.5%, 60% away. 3.5% inflation would tell you, using the rule of 70 seconds, you divide 3.5 into 72, which tells you how long before your principal doubles, and you have divided by every 20 years, the value is cut in half. That number is wrong, as we know it is. And John Williams tells us, no, inflation, the way they used to calculate it, is 11%. So you take 72 divided by 11, and every 6.5 years, your money is cut in half, its value, or how long it takes for your principal to double. Do it backwards, it's cut in half. So every 6.5 years, that money that you're selling your oil, which is a finite supply, getting harder and harder to find, it's disappearing in nature. It's why do we want to sell it for dollars that are losing value to inflation, especially when the government lies about those metrics of inflation, totally lies about them. So there's an article that I read by a man named John Little, and I give him credit whenever I can. He's a hell of a researcher. He truly is. And he came out with this very interesting article, and I adjusted it to speak to where we are now. But with gold at $2,590 an ounce and oil at $70 a barrel, that's 37 barrels of oil for 1 ounce of gold. So you could take 25.90 for those 37 barrels, or you could take 1 ounce of gold. So look at it this way. A woman's purse that could hold 20 pounds or a backpack that you could run to the car with, that's about 290 ounces. That's worth 10,730 barrels of oil. If you're the Saudis, what do you want? Do you want 290 ounces of gold, which is appreciated by 9.9% per year for 25 years, outpacing every traditional asset, period, that the Bank of International Settlements has reclassified as the world's only other tier one asset that the central banks are buying at a level the world has never seen before and repatriating it, including Saudi, who brought all their gold home from the Bank of England and the New York Fed, the two traditional places of safety that would give access to the hubs of trading, the LBMA and the COMEX? Or do you want gold? And I think that's what these entities are doing. They're saying, I don't want dollars anymore. They can be weaponized. They're being inflated. It's crap. I'd rather have gold, which has a much better track.
During the interview, AndySchectman questions the Federal Reserve's credibility, citing past misjudgments and manipulated economic data. He warns that lowering rates amid record-high stock markets and ballooning national debt could lead to severe market collapses, similar to past attempts in other countries. The Federal Reserve announced a 0.5 percentage point interest rate cut on Wednesday, the first decrease in 4 years. Many economists see this as the end of an era and the beginning of the end of the central bank's fight against inflation. A rate cut will also weaken the dollar, which has fallen against most major currencies, including the pound, in anticipation of the Fed decision over the past year. A weaker dollar will make it easier for U.S. firms to export, but the broader improvement to the global economic outlook will benefit the global economy. However, central banks are being trapped between inflation and austerity. Andy warns that lowering rates will eventually collapse the dollar. He points to rising gold and silver prices as signs of the market anticipating further instability due to the Fed's policies. Let's get back to the interview.
The Fed is full of shit, and you can't really take anything they say with a grain of salt. I mean, in the respect that, going all the way back to 2008 when Bernanke said the subprime crisis was contained, only to watch it blow up a week later. And the same thing is true here. There is no inflation, and then it's okay, it's only transitory, and well, then it's structural, then it's contained. And I mean, everything that they talk about just seems to be mistimed. They're talking about, in this case, lowering the federal funds rate by 50 basis points because of their dual mandate of not only fighting inflation, but also making sure there's full employment. Well, the numbers, as we know, that come out of the Bureau of Labor Statistics are fugazi. We know that. They went back and adjusted 818,000 jobs, but that doesn't take into account the couple 100,000 that they did during the year last year. So over 1 million jobs just vanished, and they touted every single month what great job they were doing on fighting, not only inflation, but making sure that the economy was strong. And look at the job creation. Not only was that fugazi coming out of a pandemic when everyone had lost their job or was mothballed, and now just the reacclimation into the system, those numbers should be parabolic, but they were off by 1 million jobs. And not only that, unemployment or employment numbers are a lagging indicator. So they would tell you that they're already a day late and a dollar short. Will they continue to do it? I don't know. I mean, when we talk about lowering the rates the way that they are, when stocks are trading at or near all-time highs, and at the same time we have our deficit out of control, creating 100,000 in debt every second, 24/7, $1 trillion every 3 months, which took 200 years to do the first time. We do it now in 3 months. We've redlined our national debt. It's 35 trillion, which doesn't even take into account unfunded liabilities of Medicare and Medicaid and Social Security and government military pensions, all that kind of stuff. At the same time, the Fed is making these mandates based upon fake macroeconomic data, like the CPI or like the jobs numbers. And so when you talk about the CPI, I just saw an interview with John Williams of Shadow Stats. I think everyone should go to his website. And he'll tell you that inflation is 11%. Add 8 to their number, and that's what you get. That 11% would be based upon the way they used to calculate it. So inflation is, in essence, almost 4 times as high as they are telling us, yet they're touting 3% or just over 3.5%, right in that range, as where they're going to pivot. That's 60+% away from where they wanted to be at 2%. They haven't tackled inflation. They haven't beaten inflation. In fact, they've raised the red flag to inflation the way they always have, the way that all governments have, and in terms of normalizing their balance sheet or quantitatively tightening. You get rates up to 5% and the whole thing starts to blow up, just like it started to blow up in 2019 when they tried to raise rates and the subprime crisis happened, just like when the UK tried to normalize their balance sheet and raise rates. What happened? The pensions started to blow up, so they backed off, just like Japan tried to normalize their balance sheet and raise rates. What happened? The Nikkei collapsed, the Dow Jones collapsed, the markets in Singapore and South Korea collapsed. All of these markets collapsed. The carry trade, they backed off. So the point of it is that we've reached a point where we're trapped between inflation and austerity, and governments do what they always do, and that is to choose inflation. Now, the question becomes, what are the unintended consequences? Think about the yen carry trade for a moment. The yen carry trade blew up because rates on the yen went up a tiny bit and the yen strengthened. So wouldn't it be the same thing if the dollar loses ground and rates fall a little bit on the dollar? Because if you're lowering rates, the dollar should fall. And it's the exact same thing in reverse. Are there consequences lurking in the weeds that we don't see? What we are doing is reigniting the inflation engine, and I think that's why you see gold, which they tried to hit right after the announcement, but here it is, right back up to $2,600 an ounce, silver back to 31. I think that it's predictable. The question is, do they continue to go down this road and lower rates? If we do, you might as well just put your head between your knees and kiss the dollar goodbye. Because if we continue to lower rates and to give in to inflation, it's over for the dollar on a long-term basis.
Deutsche Bank's analysts also expect gold prices to continue rising. Falling bond yields driven by the Federal Reserve's interest rate cuts and growing demand in China will help boost the price of the precious metal in the coming months. How do you think the ongoing shift away from the dollar will impact global financial stability? And could this lead to a new era of alternative reserve currencies? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.